Welcome to our viewers. I'm Tim Coughlin, along with Gay Truscott, and we are pleased to bring you our video presentation of Edgemoor Investment Advisors' first quarter 2023 report. Our agenda is to review the first quarter of 2023 market performance, discuss the Fed and the U.S. economy, contrast prospects for and against recession, provide our outlook for the remainder of 2023, and present our analysis of a couple of stocks. We begin with Gay for her presentation of current market and economic conditions and our outlook going forward. Gay?
Thank you, Tim. Stock and bond markets proved far more resilient in the first quarter of 2023 than most investors expected, though it was not without considerable choppiness along the way. For the quarter, the S&P 500 index posted a surprisingly strong 7.5% total return. The Bloomberg Barclays Aggregate Bond Index also returned a positive 3% in the first quarter, as long-term interest rates declined, sending bond prices higher. The yield on the 10-year Treasury note, which influences everything from mortgage rates to car loans, fell to 3.5% by quarter end, from 3.8% at the end of last year. These positive results came despite the shock to the banking system by the sudden collapse of Silicon Valley Bank and Signature Bank within just 48 hours in mid-March. This sent some financial stocks down 30% or more for the month, though the contagion hit mostly smaller regional banks, while larger money center banks fared much better. As you can see on this slide, the S&P Regional Banking ETF, shown in the blue line, was down nearly 25%, while the broader financial sector ETF, in the orange line, was off just 5.5% for the quarter. While the quick actions of the Federal Reserve and the Treasury Department certainly averted a broader banking crisis, it nonetheless highlighted the increased risks to the U.S. financial system from the rapid rise in interest rates over the last year. This likely impacted the Fed's decision to raise the short-term Fed funds rate by just 0.25% in late March, despite an expected increase of 0.5% earlier in the month. In addition, the Fed softened its language about ongoing increases, raising hope among investors that the Fed may be ready to pause its rate-raising campaign in order to avoid a widespread economic slowdown. Now to the U.S. economy. Notwithstanding these economic risks, there has been some positive economic data so far in 2023. The Atlanta Fed projects first quarter GDP growth to be 2.2%, which, while down from the fourth quarter GDP growth of 2.6%, nonetheless indicates a growing economy. Inflation is also easing, with the Consumer Price Index, or CPI, declining for the ninth straight month in March to an annualized rate of 5%. Though still stubbornly high, this marks a dramatic reduction from the 9.1% annualized rate of inflation just last June, and proves that the Fed's rate tightening actions are working. The U.S. labor market also remains robust, although slowing. The U.S. economy added 236,000 new jobs in March, roughly in line with expectations. The unemployment rate slipped to 3.5% from 3.6% in February, and the labor force participation rate continued to rise, which is considered a positive. It should be noted that the U.S. has added more than 1 million new jobs in the first 3 months of this year. There are other factors, however, weighing on this positive narrative. The Fed recently lowered its forecast for full year 2023 GDP growth to just 0.4%. And given that estimates for the first quarter GDP growth, which we just discussed, are in the range of 2%, this suggests that the U.S. could see negative GDP growth in the coming quarters. Recession is generally defined as 2 consecutive quarters of negative GDP growth. Also, the Fed is now predicting that unemployment will rise from the current rate of 3.5% to 4.5% by the end of the year. And corporate earnings are contracting. S&P 500 earnings declined 4.6% in the fourth quarter of 2022 and are forecasted to decline again in the first quarter of 2023, as shown in the middle blue light bar in this slide. The main drivers for declining earnings are higher costs for materials, transportation, and labor, which are increasingly cutting into corporate profits, despite growing top-line revenues in many sectors. Still, some argue that a recession may not be inevitable. Those in that camp point out that inflation appears to have peaked, supply chain woes have eased, China has reopened its economy after multiple COVID lockdowns, and oil prices remain low, at least for now. We'll see who is right. Given all these competing factors, our near-term outlook for the economy and markets is mixed. Stock valuations are neither expensive nor are they cheap. The 12-month forward price-to-earnings ratio of the S&P 500 is currently about 18 times, below the 5-year average of 18.5 times, but above the 10-year average of 17.3 times. Hence, we remain cautious in our approach to new equity investments and continue to favor short-term Treasury bills yielding 4.5% to 5% for excess cash. The political landscape also remains uncertain, with the congressional vote on the U.S. debt ceiling lurking this summer. And OPEC's recent decision to cut oil production will likely send oil prices higher at the start of the busy summer driving season, further muddying the economic waters. Therefore, we expect market volatility to remain elevated until there is more clarity on interest rates, inflation, corporate earnings, and world economic growth. Now I will turn it back over to Tim to discuss portfolio implications and actions and to discuss 2 of the securities we are currently buying.
Thank you, Gay. As we consider the current economic and market conditions, we don't panic and sell good investments at distressed prices. We are maintaining our long-term, value-oriented investment philosophy, and as Gay has mentioned, we are cautiously making new investments. 2 of these investments are stocks we have owned in our portfolios for a long time and which we continue to buy in new client portfolios which don't already own them. The first is Apple, and the second is Lowe's. Founded in 1976 in Steve Jobs' garage, Apple has recently regained its status as the largest company in the S&P 500 index, as measured by its market capitalization of $2.6 trillion. Apple is best known for its iPhone, which was introduced in 2007 and accounted for 52% of revenues in fiscal 2022. Despite that longevity, the iPhone is still taking market share from its competitors, as measured by Apple's global smartphone revenue share reaching 50% for 2022, up from 44% in 2021. Beyond the iPhone, Apple's other key hardware products include the iPad, Mac, Apple Watch, and AirPods, each filling a niche that enhances the experience of the user. The integration of the iOS operating system across all Apple devices has created a unique ecosystem that leads to a seamless user experience, high switching costs, and unmatched customer loyalty. Apple has further capitalized on its ecosystem by expanding into software and services to boost margins and create more sustainable revenue streams. Revenues from services, which include the App Store, iCloud, Apple TV Plus, Apple Care, licensing, and other services, totaled over $78 billion in fiscal 2022, 20% of total revenues, and grew at an impressive 14% annual rate. The company now has an active installed base of 2 billion devices and more than 935 million paid service subscriptions. Given this massive installed base and the continual need for device upgrades, we expect the company to generate sufficient cash flow that is increasingly returned to shareholders through share repurchases and dividends. In 2022, Apple added another $90 billion to its share buyback authorization and increased its dividend by 5%. The company ended calendar year 2022 with $54 billion of net cash on its balance sheet and is expected to generate north of $100 billion in free cash flow in fiscal 2023. Apple's stock trades at a forward PE multiple of nearly 28 times, which is a premium to its peers and to the market. However, we believe that premium is justified given its strong cash flow generation, growing installed user base, and increasing higher margin services revenue. Lowe's is a Fortune 50 company and the world's second largest home improvement retailer, generating $97 billion in annual sales and operating 1,738 home improvement stores throughout the United States. Lowe's recently completed sale of its Canadian retail business, which operated 232 stores in Canada, and it should lead to better margin performance and higher capital efficiency for the company going forward. The home improvement market is highly fragmented, and Lowe's enormous size and scale afforded numerous advantages over smaller competitors, including an extensive distribution network, economies of scale, and the brand awareness it has built with consumers and professionals. CEO Marvin Ellison joined Lowe's in 2018 from JCPenney and Home Depot and has worked to improve the company's operations, which he has done. As a result, Lowe's has been able to capture a higher percentage of earnings from its growing revenue. Net sales have grown 41% from $69 billion in 2017 to $97 billion as of 2023, while adjusted diluted earnings per share increased 215% over that same time period. Lowe's should benefit from the work-from-home preference held by many companies and individuals. Increasingly, households with record home equity value are staying put and remodeling their homes. Lowe's shares currently yield 2.1% and trade for 15 times its January fiscal year-end 2023 earnings, which is well below its 5-year average price-earnings ratio and the S&P's PE ratio as well. Lowe's is shareholder-friendly, paying $2.4 billion in dividends and repurchasing $14 billion of stock in 2022. Given the company's dominant market position, durable earnings, and robust cash flow, we believe Lowe's is a high-quality business with a long runway of growth ahead, and its shares are currently priced at an attractive discount to its long-term average valuations. Gay and I have now completed our report on current economic and investment market conditions and 2 stocks we are currently purchasing. Thanks for tuning into our report. If you have any questions or comments about our report, just give us a call.